Hello, everybody. My name is Richard Green, and I'm director of the USC Lusk Center for Real Estate, here to talk about buy, borrow, and die, the way people invest in real estate and don't pay a lot of taxes legally in the process. I first heard the term buy, borrow, die from my USC Gould School of Law colleague, Ed McCaffrey. Apparently, it has some currency, and it does explain how people can make money in real estate and pay much less in taxes than the rest of us. Now, let me start with a couple of caveats. I'm not a tax attorney. I'm not an accountant. I can't do your taxes for you. Do not take this as investment advice. Take it instead as an explanation for how tax policy allows real estate to be more lightly taxed than other assets. So we're going to start with a simple example, and we're going to make some assumptions about it. The simple example is this. Somebody buys a warehouse for $1 million. That warehouse throws off $50,000 of income a year, of net income a year. And we're going to say that the warehouse has a 10-year lease that is called a net lease or a triple net lease. What that means is that the landlord collects money on top of expenses. So the tenant pays the expenses. The landlord gets some sum of money above that, and we are going to say that that amount is $50,000 a year for the first 10 years. We're then going to say that every 10 years after that, the landlord can raise rents by 30%, so slightly less than 3% a year compounded, a fairly realistic assumption. We're going to say that the owner of this property owns the building for 40 years, at which point he or she passes away and passes the property on to heirs, very likely children. We're also going to assume that the person can buy the property with a mortgage that is equal to 70% of the value of the property and will pay an interest rate of that mortgage of 4%. Now, rates are higher as of this taping, but they were actually under 4 until quite recently. It's not particularly important what the rate is. We can talk some more about that. We're just going to say 4% today. And then we're going to assume that this owner of the property takes full advantage of IRS rules surrounding depreciation. And because of this combination of events, we're going to show that the owner of this real estate pays much less money on the cash that the real estate throws off than most of us pay for our jobs. So let's start with those of us whose principal source of income is a job. The thing about that income is you basically cannot shelter it. The IRS sees what it is. There's very little you can deduct against it. As it happens, mortgage interest on new mortgages up to $750,000 can be deducted against that, but that's kind of it. You can deduct your state and local taxes up to $10,000 against it, but that's it. For most Americans, the vast majority of Americans, actually about 90% of Americans, there are no deductions worth taking against ordinary income. So you just pay taxes based on your marginal tax rate, and that's determined by your income. The highest personal marginal tax rate is 37%. Most people pay something less than that, but as I'm going to show you, they still pay considerably more than one effectively pays for owning real estate. So here we have the property that I described. It starts with an income of $50,000 a year, and as I said, it's going to have that income every year for 10 years, at which point it will rise by 30%. It will then be $65,000, 30% higher for another 10 years, and then it rises by another 30%. And then 10 years later, it rises by another 30%. And then in year 41, and this is going to matter to us in terms of computing how much we get when we sell the property, it's going to rise by yet another 30%. We're going to get a mortgage. What's the size of the mortgage? Well, I said that you could get a 70% mortgage on your $1 million when you initially buy the property. So that's a $700,000 mortgage. You're paying 4% interest, and we're going to have this investor receive what's called an interest-only mortgage, which means that their payment is simply the interest due on the mortgage. They are not amortizing. Now, more often than not, lenders will require some amortizing, but not always. In this instance, we're doing an interest-only mortgage because I just want to make the math very simple. But the fundamental analysis we're talking about here won't change if we have some amortization. All right. So we have debt service for 10 years of $28,000, and then the mortgage needs to be refinanced. It has a due period of 10 years after it's originated, or a term of 10 years. But this is an opportunity because, again, the owner of the property can get a mortgage up to 70% of the value of the property. What happens in year 11 is income goes up to $65,000. If we capitalize that by our capitalization rate of 5%, capitalization rate is the ratio of the income a property produces divided by its sale price, that property has now gone from having $1 million of value to $1.3 million of value. This is not an aggressive assumption, again, for a 10-year horizon. We are still assuming the property is increasing in value by less than 3% a year. That happens all the time. In fact, very often property appreciates by more than that. In fact, in industrial property over the last 20 to 30 years, it's appreciated much more rapidly than that. So we are not using an aggressive assumption here about appreciation. Okay, what does that allow the owner to do? Well, they're going to refinance the loan at 70%. Their old loan had a balance of $750,000. The new loan is going to have a balance based on $1.3 million, right? Because that's the new value of the property. What's 70% of 1.3 million? Well, let's do the math. 70% of 1 million is 700,000. 70% of 300,000 is 210,000. So we're going to replace our $700,000 loan with a $910,000 loan, which means we're going to be able to pull out $210,000 of cash. Now that's money that I, as the owner, can use to buy a car, to go on vacation, to invest in something else. But because it's a loan that I have to pay back, it's not counted as income. And so I do not pay taxes on that. Now, there's not a free lunch. As you can see, my debt service goes up. The amount of mortgage payment I have to make goes up. But still, if I look at what is my cash flow, and this column is before tax cash flow, even after I'm paying more for this mortgage, because my income from rent is going up, my before tax cash flow after the refinance is still higher than it was before the refinance. In the meantime, I have taken in cash flow, which is the sum of before tax cash flow, my net operating income less my debt service plus this amount of money I pull up. I get $238,000 here. Similar exercise that allows me to pull out $273,000 in year 21, $354,000 in year 31, and as you can see, my operating cash flow continues to rise through this period of time. Now, once again, I'm going to assume that I'm going to sell the property in year 40. And so if I sell the property in year 40, I'm going to sell it based on an income of $142,805. That takes me to a sale price based on that 5% cap rate of $2.8 million. My new mortgage balance, I can compute that by just looking at what is my mortgage payment divided by the mortgage interest rate, because it's interest-only mortgage. That amount is $1.537 million. And so I net $1.38 million in cash when I sell the property. Okay. Now, what about taxes? Well, to figure out taxes, we have to compute taxable income. What is taxable income when we own the property? It is simply my net operating income less, again, in this case, my debt service, because all of my debt service is interest. Now, if I have an amortizing loan, like a home mortgage is, then the principal part of that amortizing is not tax deductible. The reasoning is that you are not reducing your income. You're just converting your balance sheet from cash to equity in a property. So you're not permitted to deduct the principal part of debt service, but interest is deductible. And in this case, debt service and interest are the same. And then on top of that, you get to deduct something called depreciation. How does depreciation work? Well, in this instance, we're going to say the building is worth 75% of the value of the property. This is important because you are allowed to depreciate improvements, buildings, but you are not allowed to depreciate land. According to IRS rules right now, the length of time over which you depreciate a commercial property, and an industrial property is a commercial property, is 39 years. What does that mean? Well, in the first year, there's something called a mid-month convention, or mid-year convention, which means you typically depreciate half a year. And so what we're going to do is we're going to say, okay, here's what we bought the property for. Here's the amount that's the building. So that's what we're allowed to depreciate. And then we're going to divide it by 39, the number of years, by 2, which is reflecting the fact that we're depreciating 6 months. And so that's $9,000 in the first year. But after that, we are taking 1/39th of that $750,000 every year. So all the way down to year 39. Then in year 40, we're going to take that last 6 months. So here are 38 years of 139th and then 178th, 178th. And if we look, all of this depreciation, we can see here adds up to $750,000. If you don't like that way of looking at it, we could just sum it up like so. And you can see we have fully depreciated the building. Okay, now, if we were to sell this building and it's the original owner who sells it, now they're going to have a tax event. And it's not just because you're selling the building at $2.8 million for considerably more than you paid for the building, which is $1 million, but also because you've depreciated the building down so that its book value to the IRS is $250,000. Why is that? Because you had $1 million, you depreciated at $750,000. So what is called your adjusted basis is $250,000. You've sold this building for $2.856 million. And as a result of that, you are going to have to pay capital gains on the difference between $2.856 million and $250,000. That is a considerable gain. The other thing is you're going to pay at two rates. If you recapture depreciation, so basically we're saying here for tax purposes, we have a property that's depreciated, whereas the reality is that it has appreciated, you're going to pay 25% back of that $750,000 that you depreciated. And then everything on top of that, you're going to pay 20% in all likelihood. Depends on your situation. Now, if you live in California, because we can no longer deduct state and local taxes, it's going to be more than that. If you are in the top California tax bracket, which is 13%, you're going to pay 33% of this in capital gains tax. But here is where the die comes in. Buy, borrow, die. If your dependents, or anyone else for that matter, inherits your property at the time that you pass away, there is something called a step up in basis. What does that mean? It means that the new book value of the property, which determines the taxes that you pay, is equal to the value at the time that the heirs inherit the property. And so instead of there being a major tax event at sale, it goes away. So imagine the owner of this property has planned exceptionally well. Let's say they're 55 years old when they buy it and they know with certainty that they're going to die at 95. What that means is there's going to be no capital gains tax involved. So let's look at what happens to our taxes. We're going to assume a 37% tax rate. That is your statutory tax rate. Your taxable income, as I said, is your NOI, less your debt service, less your depreciation. So the taxes you pay in the first year are $4,500. But in the second year, once we're allowed to take a full year of depreciation, your taxes are $1,000. Well, let's start by looking at this. Your before tax cash flow is $22,000. That's the money that comes in. At $1,000, you are paying less than 5% of that cash flow in taxes. And so it is until you get to the year in which you are first permitted to pull money out, or where you will pull money out because you refinance. Now you are paying barely more than 1% of your cash flow in taxes. And then we're going back to, something like 4%, 5%, and so on. So notice, again, the statutory rate is 37%, but relative to the cash that you get in, your taxes are in the neighborhood of 4 to 5%. But then if you pass away, again, you're paying taxes on this last year, and it's based on slower depreciation, but you're not paying any tax on this $1.3 million. And remember, you've only paid $300,000 because you got a $700,000 mortgage. I mean, you paid $1 million for the property, but you were out of pocket $300,000. Okay, when we look at what all this means, we can do the following. We can look at what are the returns to this deal on a before tax basis and on an after tax basis. Here are our before tax cash flows. Okay, they go here. Here are our after tax cash flows. They go here, okay? And what we can do is use the internal rate of return function in Excel to find out the return under those two sets of cash flows. What we find is our before tax return is 12.5%. Our after tax return is 11.9%. So our effective tax rate is going to be how much money do we make after tax divided by how much money do we make before tax. That's what we get to keep. 1 minus that is what we have to pay. So our tax payment is about 4.7% in a world where the statutory tax rate, as I said, is 37%. Now, you might be saying, well, okay, but what about if people don't die? They hang on to the property. Well, here is the thing, and I don't want to get into the technical aspects of it in this video. What you can do is exchange property. And by that, I mean, you can say, all right, I have a property that's worth $2.8 million. I'm going to sell it and then buy another property for $2.8 million. And while I can't depreciate any more the original $750,000, I can depreciate the value that's above that original amount that I paid for the property. So as a result of that, I can basically put off my capital gains until perhaps I die, which means, again, I escape the tax man, because at that time, whenever it happens to be, I can do a step up in basis. And so this is all perfectly straightforward. This is all perfectly legal. There is nothing here that would cause consternation in the IRS. Well, it might, because they might not think that this should be policy. But this is very straightforward and explains why real estate is a very good way to shelter income relative to other kinds of income that we see in the economy.